With over 40 years of experience working with some of Canada's largest institutional investors and hundreds of everyday Canadians, I've seen what actually leads to the creation of wealth. And here's the truth, it's not about chasing stock tips or timing the market. The real magic lies in a few timeless habits, and they're simple, but admittedly, they're not always easy to put in place. Now, in this video, I'm going to break down the 5 key habits or behaviors that lead to better long-term results. These are results that deliver a more secure life after work and greater confidence along the way. I'll draw from classic books and some landmark research and some real-world lessons from our clients at Steadyhand. All right, 5 habits. Number 1, automate your savings by paying yourself first. Now, this mantra was made famous by David Chilton in his Canadian classic, The Wealthy Barber. Now, what's the idea? Okay, before you pay your bills, pay your future self. Set up automatic contributions to your RSP, your TFSA, or your investment account right from your bank account as soon as your paycheck clears. Now, automation will turn good intentions into real progress. It's going to remove willpower from the equation. And in my experience, willpower can be unreliable at best. In fact, studies show that automation improves savings rates and reduces financial stress. Nobel Peace Prize winning economist Richard Thaler, in his book Nudge, argues that defaults like auto-enrollment and auto-contribution are powerful tools to overcome inertia. And inertia is clearly one of the biggest barriers to wealth building. All right, number 2, diversify. Diversification is really investing's version of just don't bet the farm. Harry Markovich, the father of modern portfolio theory, calls diversification the only free lunch in investing, and he claims to eat a lot of it. It spreads risk and return across different asset classes like stocks and bonds, and different industries like technology, finance, healthcare, and commodities, and different geographies. So when tech stocks are down, dividend-paying stocks and bonds might be up or hold steady. When Canadian or US markets are lagging, international markets might be leading. Now, diversification won't eliminate your losses, but it can certainly smooth the ride, helping you stay invested through thick and thin. And yeah, it's been a few tough years to be diversified, especially with those Mag 7 tech giants leading the charge. But history tells us that leadership does change. And when it does, diversified investors are ready to take advantage. Okay, number 3, be patient. You may have heard it's time in the market, not timing the market. And if you're trying to time the market, well, frankly, it's fiction to think that you or anyone else can. No one can consistently predict the future. Morningstar and Delbar studies show that investors routinely underperform the very funds that they're invested in because they buy high, sell low, and move in and out at exactly the wrong times. And here's a strange but true story. Fidelity Investments once looked at its best performing accounts. Many of them belonged to investors who forgot that they even had them, and some have even passed away, and the accounts were left untouched for years. So stay invested and let compounding, or what Einstein called the 8th wonder of the world, do its magical work. Time can turn chaos into opportunity, and wealth creation is ultimately the combination of discipline and patience. Okay, habit number 4, costs. They matter a lot. Now, fees may seem small, but over time, they add up a lot. And according to the T-Rex fee scoring model created by Beat the Bank author Larry Banks, a 2% annual fee on a $100,000 portfolio can quietly consume over $160,000 in returns over 25 years. That's about half of your total gains, assuming a 6%, which is reasonable, pre-fee rate of return. At Steadyhand, we believe in keeping costs low and transparent, so you know exactly what you're paying, and you can keep more of what you earn. As Vanguard founder Jack Bogle famously said, in investing, you get what you don't pay for. Now, low-cost investing doesn't mean no advice. It just means smart, fair, reasonable fees that support your goals without eating into them. All right, the 5th and final habit, and it's the most important. It's emotions and behavior, and I think they matter more than everything else. Investor psychology often sabotages even the best strategies. I mentioned earlier, panic selling during market drops or chasing hot stocks after they've already soared. acting on tips from your Uber driver or your golf buddy, and reacting to headlines as if those were actually financial forecasts. Going back to Delbar, the average investor, according to their studies, underperforms the market by 3 to 4% every single year. Now, this is partly due to fees, but it's also partly due to poor decisions. It's what we call in our industry the behavior gap. It's the difference between what an investment earns and what an investor in that investment earns. Now, why is this? Well, Carl Richards, author of The Behavior Gap, illustrates it perfectly. We tend to buy high when we're excited and greedy, and we tend to sell low when we're fearful. At Steadyhand, a big part of our role is indeed helping you stay the course, and it's why we named the firm Steadyhand, because market volatility, frankly, it's not a bug, it's a feature. And so mastering your behavior is the key to long-term success. Now, successful investing isn't about predicting the next hot stock or calling the next correction. That's a fool's game. It is about building a process that you can stick with through both bull markets, bear markets, and everything in between. Those 5 habits again: automate, diversify, be patient, really watch the costs and the fees you pay, and master those emotions. With those 5 habits will come a few powerful outcomes. You'll be more confident, you'll be creating wealth, and with both of those, you're going to have an enormous amount of peace of mind as you head towards or you're living in retirement. Now, if this video resonated with you, I invite you to click the subscribe button. And if you're looking for a steady hand to guide you, well, that's what we're here for. And we'd love to have a conversation. Thank you for watching, and I look forward to seeing you the next time.